One of the most polarizing topics in the stock market over the past 3 years has been whether artificial intelligence is forming a bubble. If you have followed the progress of AI since OpenAI first released GPT-1, you have watched the technology grow into a global industry that is attracting hundreds of billions of dollars in spending. ChatGPT quickly gained a large audience and pushed companies like Microsoft, Google, Meta, and Amazon to speed up their own AI plans. And with that rapid growth and massive spending, the debate over whether AI is forming a bubble has continued. And when I say AI spending, let me explain just how much we're talking here. In 2025 alone, Amazon, Microsoft, Alphabet, and Meta have spent about 410 billion combined on data centers, chips, servers, and other infrastructures. When tech companies increase their AI spending, it is no surprise that AI stocks grow, especially the semiconductor industry. Morningstar reported in May 2026 that the market value of the semiconductor industry had grown from about 2.2 trillion in May 2023 to 9.4 trillion in April 2026. That means the industry's value more than quadrupled in less than 3 years. Morningstar also found that the broad US stock market had gained about 85.6% since May 2023. Semiconductor stocks created almost 23 percentage points of that gain, while Nvidia also created more than 12 percentage points. This shows how much the market has depended on a small group of AI winners. Another problem is that spending is beginning to rise faster than cash generation. It's estimated that the five largest hyperscalers could spend more on capital expenditures than they produce in free cash flow by 2027. Their annual operating cash flow is expected to increase by about 340 billion between 2025 and 2027. However, their capital spending is expected to rise by around 534 billion. Microsoft reported 35.8 billion in operating cash flow during one fiscal quarter, but it recorded 37.5 billion in capital spending when finance leases were included. Amazon's trailing 12-month operating cash flow increased to 148.5 billion, but its free cash flow dropped to only 1.2 billion. Oracle's capital spending reached 55.7 billion during its 2026 fiscal year, compared with operating cash flow of 32 billion. Oracle also announced plans to raise between 45 billion and 50 billion through debt and stock sales to support its cloud expansion. This does not automatically mean you should panic, but it does mean companies must produce much more AI revenue to justify what they are spending. There has been hundreds of predictions about an AI market crash across YouTube, X, podcasts, newsletters, and financial television. I am not the first person to make a video about this topic, and I won't be the last. Most of our favorite finance influencers have probably already shared their opinion, but I want to focus on several well-known figures in the finance and explain their main argument about a possible AI bubble. Let's look at Michael Burry, who has been very vocal about this topic. Michael Burry's main concern was overinvestments. He argued that technology companies were spending too much on chips and data centers that could become outdated faster than expected. Burry had also placed a bearish bet against Nvidia, Palantir, and Micron, three companies closely connected to the AI trade. He believes AI chips are improving quickly. If a company spends billions of dollars on today's equipment, new chips could make that equipment less valuable within a few years. If AI revenue does not rise fast enough, those expensive assets may never produce the expected return. Jimmy Grantham, who is a co-founder of an investment firm GMO and has studied finance bubbles for decades, is also cautious right now. In July, Grantham described the AI-driven market surge as one of the largest bubbles in history. He warned that the market could eventually fall by as much as 70%. He encouraged investors to reduce exposure to expensive US technology stocks and hold a wider mix of international stocks, bonds, real estate, and precious metals. Grantham says the AI boom is similar to past tech bubbles, such as the railroads and the internet. Those technologies changed the world, but investors still lost money because too much capital entered the industry too quickly. Hundreds of companies built competing systems, prices fell, profits disappeared, and weaker businesses failed. Grantham believes AI could follow the same path. However, I do want to point out that Grantham has warned about a major market crash for years. The market continued rising through several of his earlier warnings. That does not prove he is wrong today, but it does show that identifying a bubble and predicting when it will burst are two different things. If demand falls below expectations, data centers could have unused capacity. At the same time, competition could force companies to lower AI prices. That combination would create lower revenue and weaker returns on very expensive assets. Economist Dean Baker, who warned about both the dot-com bubble and the housing bubble, has also questioned whether the AI stock surge can continue. Baker reduced his exposure to AI trade because he believed prices and expectations had become too difficult to justify. Many other market analysts have all had the same concerns, but if you're wondering why we haven't seen a major pullback yet, I like to remind you guys of some things. There is one major reason the AI boom has survived these warnings. The companies are still producing real growth. A lot of people like to compare today to the dot-com bubble of the late 1990s. During the late 1990s, many internet companies reached huge valuation despite having little revenue, no profit, and honestly not so great business model. A great example would be how Pets.com operated at that time. Pets.com sold low margin pet supplies online while spending heavily on advertising and shipping. Its costs were higher than its revenue. They were struggling as a business, and the dot-com bubble completely wiped them out. Today's biggest AI spenders, Amazon, Microsoft, Alphabet, and Meta, are highly profitable companies with large customer bases and strong cash flow. They also have established businesses outside of AI. This does not mean AI stock cannot become overvalued, but the boom is being supported by real earnings and demand, not just promises about the future. Fidelity calculated that the 7 largest stocks in 1999 trade at an average of almost 66 times expected earnings. By comparison, the Magnificent 7 traded at an average of about 28 times expected earnings at the end of 2025. Tech stocks are expensive today, but they remain far below the extreme valuation reached by the largest dot-com stocks. Financial bubbles usually do not burst because people suddenly decided technology is useless. They burst when reality fails to meet extremely high expectations. So here is my final thoughts on this topic. I don't think we're in an AI bubble, but I do see a major pullback in the near future. But the major AI companies will recover because AI isn't going anywhere. That being said, this does not mean every AI investment is safe. Some companies may be overpriced or spending more than they will ever earn. AI itself is probably not a bubble, but parts of the market may be. The key is finding companies that can turn AI growth into lasting profits. If you enjoyed this video covering the AI bubble, check out my other stock related videos. Until next time, goodbye.